So guys, the market in March has been sliding harder than Trey Turner, with so many stocks seeing big drops, and there are no signs that this volatility is slowing down. Nonetheless, all that red has created some great opportunities to swoop up shares of your favorite dividend stocks at a discount. And in today's video, we'll be discussing 3 stocks that seem like particularly great buys as we head into April. But real quick, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. And also guys, if you want to keep track of how all my stock picks in this series are performing, I put together a free public scoreboard where you can see everything in one place. This spreadsheet tracks how all of my stock picks have done since mentioning them in these videos. And if you want access to this spreadsheet, just click the link in the description or in the pinned comment. Anyway guys, getting into our first stock of the day, Pool Corporation is the world's largest wholesale distributor of pool supplies with around 440 sales centers around the world, and it's also one of the more recent additions to Warren Buffett's portfolio. Now, one of the things that I like most about this company is that more than 80% of its revenue comes from recurring maintenance and replacement costs. You know, things like chemicals, filters, and pumps, which are all essentials that pool owners have to purchase on a regular basis. Now, overall, at least to me, Pool Corporation seems like a very high quality company. But taking a look at the share price performance over here on Snapstock, as of late, the share price performance has been pretty terrible. In the last month, Pool Corporation is down about 7.5%. So a pretty big drop here. And if we look at the year-to-date performance, the company is down about 5.4%. So another decent drop in the red here in 2025. And if we zoom out once more over the last year, this is where we'll see the biggest drop. In the last year, Pool Corporation is down 22.7%. And then going back to the 1-month performance right here, looking at this roller coaster, guys, we can see the share price used to be quite a bit higher, and very recently too. It peaked at around $372 per share before making its way down to where it's at now, just under $320 per share. And my only guess is that that crazy of a swing in share price has more to do with a lot of the macroeconomic uncertainty that's going on, rather than it does anything fundamentally wrong with the company itself. And overall, like I said, Pool Corporation looks to be a very high quality company. I mean, looking at the Snap score, it's got a 7.75 out of 10, so it's very above average. And the Snap score, guys, is something that we actually just recently rolled out to Snapstock. And long story short, basically, this takes all of the different categories that we use to gauge a stock, looking at the growth, profitability, debt, dividends and buybacks, and capital efficiency, and it puts it all together to put out an overall Snap score to help you gauge how high quality or low quality a company might be. And so a 7.75 out of 10 is very good, and we can see that it's scoring pretty high in most of the categories here. Growth is a 7 out of 10, so it's a pretty growthy company. Profitability is 4 out of 10, which is on the lower end, but this makes sense because Pool Corporation is a distributor, so they have to be pretty competitive on their pricing, which is why the profitability is going to be lower. This company naturally is just going to have lower margins, which is going to result in a lower profitability score here. Overall, it's really nothing to be concerned about. And if we look at the other 3 categories here, debt has a really high score, 8 out of 10, dividends and buybacks, 9 out of 10, and capital efficiency, which is the return on assets, return on equity, and return on invested capital, have a perfect score, a 10 out of 10. And we'll just scroll down and take a look at some of these categories, starting with growth. So scrolling down all the way here, we can see that for the most part, Pool Corporation has been a very growthy company over the last decade. For the most part, all of these charts are up and to the right. And looking at the revenue and earnings per share, we can see that these pandemic years here saw a lot of growth. And since then, things have kind of leveled out a little bit, starting to return to homeostasis. And we certainly see that here with the earnings per share, a big pop in 2020 to 2022. And since then, it's kind of started to return back to normal, but still the overall trend here is up and to the right. And it makes sense to see this because during those pandemic years, 2020 to 2022, demand for pools and outdoor living spaces was likely very high because people were just spending more time at home due to everything going on. So as a result, there was a big boom in new pool construction, and because of that, a boom in maintenance needs for those pools, which obviously would be reflected in the numbers of a company like Pool Corporation. Nonetheless, I still think things are looking pretty good here, and the free cash flow per share really hasn't skipped a beat. This has been a really nice growth trajectory, and over the last 5 years, it looks like it's grown at an average rate of about 14%, and it's even higher over the 10-year period. And then scrolling down, looking at the debt situation, just as a reminder, it's got an 8 out of 10, and I can see why. The company did see a pretty big jump in debt here, between 2020 and 2021, but still, recently it has come down, and more importantly, the net debt to free cash flow is still in great shape. And then guys, the moment we've all been waiting for, getting into the dividends. So starting here with the yield, on the surface, the dividend yield isn't going to be anything super exciting. In the trailing 12 months is about 1.5%, but this is about 50% higher than the company's 5-year average yield and the 10-year average yield. So the yield is way higher than usual, and historically the company's been a very solid dividend grower with a 5-year CAGR at about 20% and a 10-year really not too far behind that. And importantly, the dividend looks to be very well covered. In the trailing 12 months here, the earnings payout ratio is only 42.3%, and the free cash flow payout ratio is actually even lower. It's only 30.4%. So plenty of room to continue paying and growing that dividend. So I actually think Pool Corporation is a pretty interesting company. I actually have this one sitting on my watch list, and at the very least, I think it's worth keeping an eye on because there just seems to be a lot to like about this company. So guys, this next stock, which is Target, is a company I think we're all familiar with. It needs no introduction, but if we had to give it one, let it be known that Target is the most oversold stock in the S&P 500. Looking at the share price performance just in the last 30 days, the stock is down 17%, which is going to leave it with a year-to-date loss of just over 23%. And zooming out once more over the last year, it's pretty crazy, guys. Target is down 36.65%, and at this rate, if it just keeps going, it's going to be under $100 per share, really any day now. Now, like with Pool Corporation, a lot of this just seems to be macroeconomic stuff. There doesn't seem to be anything inherently wrong with Target to warrant this substantial decline. And if we take a quick look at some of these valuation stats here, starting with the PE ratio, this is looking very low. It's sitting right below 12, which is considerably lower than the company's 5-year average of 19.5. So that looks pretty promising. And similarly, looking at the free cash flow yield right here, it's sitting at 9.4. This is a very, very high free cash flow yield, and it is sitting at about twice the 5-year average. So if nothing else, Target looks to be incredibly cheap right now. And even with that, considering how mature this company is and how long it's been around, I mean, it's dividend king, so it's been growing its dividend for more than 50 years. And considering all of that, I think the company's still been growing at a pretty respectable rate. I mean, looking at the Snap score in the growth department, Target is given a 5, which isn't terrible considering how long this company's been around, considering that it is a mature business. I think a 5 out of 10 makes sense. And if we look at the charts here, we can see that, yeah, that's probably spot on. I mean, the revenue growth rate over the last 5 years, pretty nice, 8.3%. It looks like sales have stagnated a bit these last couple of years, but still the CAGRs are good. And the same is true with the earnings per share, 8.72, so right in line with revenue. Pretty respectable earnings growth rate with a slight dip here in 2023. And on the free cash flow side, a really big dip actually. In 2023, they saw negative free cash flow, but they were having some inventory issues that year. It looks like they seem to have worked those out because free cash flow per share really jumped back up here in 2024. Now, guys, I'll be honest, it's usually hard for me to get excited about owning any of these retailers, whether it's Target or Walmart, Kroger, Dick's Sporting Goods. They're usually just other businesses I would rather own. But looking at Target's dividend stats, guys, I've got to give it to them. It's looking pretty tempting. I mean, the 5-year average yield is 2.1%. Okay, so pretty moderate yield, but right now you can lock in a 4.3% yield. So basically twice the 5-year average yield by buying at current prices. So that's pretty juicy, and a 4.3% yield in its own right is getting into high yield territory, at least in my mind. And with that, you're getting what's been a pretty decent dividend growth stock. The 5-year CAGR is 13.5%. The 10 years a bit lower at 8.3%, but still, a 4.3% yield paired with an 8.3% 5-year growth rate, I think you could do worse. And when you combine these two here, the high yield with the growth rate, I think that makes Target double trouble in the dividend department, and the dividend still looks to be pretty well covered. We've got a payout ratio at about 50% in the trailing 12 months and a free cash flow payout ratio that's actually a bit lower at 46%. So I guess with that said, if there ever was a time to buy Target, I think now could be it. And even though Target isn't officially on my watch list, it's getting cheap enough to the point where it's just getting really tempting. I don't know, guys. We'll see what happens. It's tricky, but Target's looking really good right now. So guys, rarely will you hear me talk about any of the semiconductor companies. They're all usually a bit over my head, but if you're into this space, I think Qualcomm is looking like a very interesting opportunity right now. Looking at the share price performance, in the last 30 days, Qualcomm's down about 4.5%, so, pretty decent drop here, but if we look at the year-to-date performance, it's still just barely in the green, just barely hanging on there, basically break even, and if we zoom out over the last year, it is down here as well. It's down about 5.8%, but with that, looking at the Snap score, this is going to be the highest quality company that we've looked at so far. And if we look a bit further into the breakdown of this score, it's going to be hard to beat this, guys. Growth, profitability, and debt are all 9s out of 10, so really strong scores there. Dividends and buybacks are going to be the weakest out of the bunch, but still a 7 out of 10. I'll take that, and a perfect score in the capital efficiency department. This is pure class, guys. This is a real work of art. And if we scroll down getting into some of these categories, starting here with the growth, this is exactly what you want to see. This is looking really good. Very strong growth CAGRs in revenue, earnings per share, and free cash flow per share. In fact, free cash flow per share is going to be the strongest out of the bunch with a near 27% 5-year growth rate. So based on that, no surprise that we're seeing, what was it, a 9 out of 10 here. Scrolling down a bit more to the debt situation, guys, the debt has actually been declining over the last 5 years. We can see that they have a negative debt growth rate. So that's really good to see. And the net debt to free cash flow is less than 1, 0.6, which means, guys, that they have more free cash flow coming in every single year than they have net debt on their balance sheet. That is a great sign. And just because of that, you don't have to worry about Qualcomm going bankrupt anytime soon. This company is just printing cash. And then looking at the dividends, guys, things are pretty good over here too. The 5-year average yield is 2.25%. And right now the yield is a bit below that, interestingly enough. And even though the dividend growth rate's not the highest, definitely not as high as actually as what we saw with both Target and Pool Corporation, still, you're getting a 7% 5-year growth rate. This is steady, and it looks like they've been able to maintain this also for 10 years. They're actually pretty neck and neck, so I think that's a good sign. And when you pair these two together here, the moderate yield with the moderate growth rate, it's no surprise that we're seeing a 7 out of 10 here. But you certainly could be doing worse, and this dividend is very well covered. We've got a 36% payout ratio here in the trailing 12 months, and looking at the free cash flow payout ratio, it's actually less than 30%. So I do think Qualcomm is looking like another solid contender if you're in the market for a great dividend growth stock. And the same is true with all 3 of these companies that we've looked at today. With that said, though, these 3 are not the only ones. There are still quite a handful of other stocks out there that I think you need to keep your eye on. The first of which, guys, is Boise Cascade Company, who's got a really high Snap score here, 8.3. Pretty solid metrics all around. Profitability is a bit low, but the rest looks good. But anyway, in the last month, BCC is down about 5.9%, which is going to leave the stock down to 17% here year to date. So definitely a good one to keep your eye on. Anyway, moving on, Caterpillar's another one to watch, guys. Another very high quality company with an 8.15 Snap score. Not too bad of a breakdown here, if you ask me. And in the last month, Caterpillar's down 1.3%, which is going to leave the stock down about 8% here in 2025. And then I know a lot of you guys out there are buying this one. This is Alphabet, who is down almost 10% in the last 30 days, which is going to leave the company down about 15% here year to date. And it looks like it's gone from a peak of about $206 per share to where it's at now, almost below $160. And the Snap score actually is lower than what we saw with the prior 2 companies. And a lot of that has to do with the dividends and buybacks. And that makes sense. I mean, Google just basically initiated a dividend, well, less than a year ago, right? So we'll have to see how things shake out over time. But with more time, this score will improve. And I think that will bump up the Snap score a bit more. Anyway, moving on to the Home Depot with a Snap score of 7.75. There's the breakdown for you guys so you can check it out. But in the last month, looking at the performance, Home Depot's down 8%. So a pretty decent drop for these guys. And if we look at the year-to-date performance, Home Depot's down 9.4%. So a pretty decent drop here for the year. And then no surprise, if Home Depot's down, there's a good chance that Lowe's is down as well. And that's certainly the case here. A similar Snap score, 7.2, so a bit lower than what we saw with the Home Depot. But looking at the share price performance, in the last month, Lowe's is down 5.2%, which is going to bring the stock down 8.9% here year to date. Anyway, moving on to the next one. I know a lot of you guys are actually buying this one as well. This is Microsoft, who's got the highest Snap score of a day. This is going to be hard to beat, guys. Look at that. And I think the only reason the dividend score is so low is because that yield is so low. But if that's the only thing working against this company, I mean, you could certainly do worse. And as far as the share price performance goes, in the last month, Microsoft's down about 3.5%, but looking looking at the year to date, it's seen quite a bigger drop. It's down about 9% here in 2025. But anyway, next up, guys, we've got Nike, definitely one to keep your eye on. This stock really just can't catch a break. And in the last month, it's down another 16%, which is just insane. If we look at the year to date, Nike is down 8.35%. It's down almost another 2% here just today. Looking at the Snap score, we still have an above average business. All of these stats are looking really good here. So I definitely think Nike is another stock to keep your eye on. Anyway, guys, moving on to the next one. This is a company that I've talked about quite a bit. I think it made an appearance in last month's video, if I remember correctly. This one is Old Dominion Freight Line, who is an above average company. Looking at that Snap score there, pretty solid. Perfect debt score, which is great to see. And the company actually has, I believe, negative net debt on the balance sheet. So that's looking really good. And looking at the performance, the stock has seen another very big drop in the last month. It's down about 11% just in the last 30 days. If we look at the year-to-date performance, Old Dominion's down about 9%. But anyway, guys, moving on to this next one, which is Wingstop. I think this was my top dividend stock to buy coming into March, but since I last talked about it, it's down another 10%. So another pretty big drop for this company, which is going to leave Wingstop down a hefty 28.5% here in 2025. So it's getting more discounted by the day, and if nothing else, I think this is one to keep on your radar. But anyway, guys, those are all of the stocks that I think are ones to keep an eye on right now. And if you want to hear about a handful of other stocks that I'm most definitely staying away from and suggest you do the same, then check out this next video right over here. In this one, you'll learn about 3 dividend stocks that many investors like to buy, but truth be told, they're terrible investments, and I think you should avoid them at all costs. So click right over here to learn about those, and I'll see you in the next one.